Hello, Matthew Bell with InsurancePrescription.com, and today I wanted to deal with a question about fixed annuities, and the question is, who do fixed annuities really benefit? Who are fixed annuity products geared toward? Who are they good for? Who are they not good for? So first of all, just as a reminder, what is an annuity? So an annuity in general is a vehicle that guards against you living too long. That is to say, outliving your monetary resources. And make no mistake, longevity risk or the risk of outliving your money is a great risk in retirement. It's one of the biggest risks. So an annuity is a contract that you would have usually with an insurance company, and that contract is going to specify periodic payments. Generally, it's geared towards lifetime payments, so provision for lifetime income, and it's usually going to start in retirement. Essentially, what an annuity is funded with is an asset that you then exchange for an income stream. Now, I have an entire video just on the mechanics of annuities, and I'll put the link in the description, so I'm not going to repeat all of what an annuity involves in this video. Suffice it to say, though, that for the present time, I'm going to be referring to fixed annuities. And so in a fixed annuity, you have some sort of a guaranteed interest rate, and in some sense, the principal, that is to say, the asset that you use to fund it, is going to be guaranteed. That's as opposed to things like variable products, which are often possibly capable of earning a higher rate of return, but come with a higher degree of risk. Generally, you could lose the principal and actually end up taking a loss. Now, one question right off the bat is, how safe is a fixed annuity? Now, when I say the principal is guaranteed, the fixed annuity is a contract, and so in general, a fixed annuity is going to be safer than a variable product. However, a fixed annuity's guarantee is only going to be as good as the company that issues it. It's going to depend in part, therefore, on the financial strength of the insurer, and their financial strength is going to be a function of things like their legal reserve, the kinds of investments that they invest in. Some of these are restricted by law, that insurance companies are not permitted to invest money in risky ventures and put money at risk that may be needed to pay out life insurance policy claims or surrenders. But there are ratings organizations. So for example, Standard & Poor's, the S&P, has a rating for insurance companies. AM Best has a rating. Fitch's, Moody's, there are various different ratings organizations, and each of these is independent from the standpoint of the insurance companies, and you can consult their rating scales to try and get a fix on whatever company you might be looking at in terms of what that company's financial strength might be. Now, the question of who a fixed annuity is going to be good for is going to be in part a function of what that person's goals are, what that person's age is, what that person's financial situation is like. So this question has got to be situated in a specific context. I cannot give you specific financial advice. I can't give you specific investment advice, certainly, or insurance advice, retirement advice, or tax advice. This video is not intended for specific advice. It is for general, informational, or entertainment purposes only. For specific, personalized recommendations, please consult with some sort of a licensed professional in your area, somebody who's familiar with your situation and with whom you can have a conversation about these things. But let's get into some generalities. So in general, a fixed annuity is going to be good for somebody who is risk averse. That is to say, if you are averse to putting your money at risk, or if you are averse to putting all of your money at risk, you might really appreciate some of the guarantees that go along with a fixed annuity. So a fixed annuity might keep all of your money, or it might keep a portion of your portfolio. The portion of your portfolio you want to keep that is not at risk, you might put into a fixed annuity, and you might let other pieces of that portfolio be at greater risk, or you might simply prefer to put all of your money into some sort of a fixed instrument. Once again, I'm not giving you advice, simply that for a person who is risk averse, either in total or risk averse over a portion of their portfolio, a fixed annuity might fit the bill. Somebody who wants fixed rate of return, for example. Fixed annuity might also be good for somebody who needs an immediate retirement income. So the way an annuity works essentially is there is a pay-in period where you fund the annuity. You can fund it with a single payment. You might fund it with periodic payments. And then there is a period of payout. And that assumes that the annuity essentially is going to be annuitized or settled and turned into an income stream. If you are in retirement presently and you simply need to convert an asset into an income stream in order to maybe give yourself a pay raise, a fixed annuity could be extraordinarily beneficial to you. particularly one that is called a single premium immediate annuity, or a SPIA, but it's not the only kind. You can take flexible annuities and you can convert them into income streams by settling them. There are different settlement options, and once again, you can consult the video where I sort of explain the nuts and bolts of an annuity, and I get into settlement options in that video. I'll put the link in the description. Now, a fixed annuity may also be appropriate for somebody who's looking for tax-deferred growth, but they also want the guarantee on their principal. So they want to be conservative with their money. But they don't want to put it into a CD or into a savings account. Often a fixed annuity is going to outstrip in terms of a rate of return. Not always, but often it will outstrip what is available in terms of even a high interest savings account or a CD. Now, there may be surrender charges, and we'll get to that in just a minute, but especially if a person maybe is in a higher income bracket or expects their tax liability to be less in the future, they may decide to put some of their money in a tax-deferred vehicle so that they don't have to pay tax on it. So that's going to be an important feature. And in another video, and I'll put the link for that in the description as well, I deal with the question of why is tax-deferred growth potentially an important consideration, and why is it attractive in some cases. So essentially, a fixed annuity is going to be good for somebody who is conservative, somebody who wants to get a guarantee on their principal, moderate growth, they don't want to lose anything, maybe they're in retirement and they need an income bump right now, or they are planning on retiring and want their annuity fixed so that they can hang their hat on some guaranteed lifetime income, and they're going to factor that into their plan, and they don't want that money at risk. Who, on the other hand, is a fixed annuity not going to be so good for? Well, first of all, a fixed annuity is not going to be an ideal vehicle for somebody who is not risk averse. So somebody who wants to chase after higher gains in the market and does not mind having some of their money at risk. For that kind of a person, a fixed annuity is not going to be the best vehicle. A person perhaps who's already in a low income tax bracket and does not really benefit from the tax deferral, because if they just paid their taxes now, they would be well situated or perhaps better off than if they deferred their taxes to a later time. So not only a person who might be in a low bracket, but a person who thinks their tax bracket might be higher down the line may not benefit from tax deferred growth. Now in general, and I deal with this in another video, tax-deferred growth is good in many cases, because if you do not have to pay taxes every year on a particular sum of money, then there's more money available to accumulate at interest. But not every person's situation is going to be ideal for that kind of tax-deferred growth. Another person for whom the fixed annuity is not going to be ideal is going to be somebody, perhaps an elderly person, who cannot afford the surrender charge. The prospect may be that they may have to access their principal, and if they put it into an annuity, they might tie it up. Now that could be even a younger person, because in many cases an annuity, being a retirement vehicle, is going to be subject to what's called the 59.5 rule, which means that if you put money in, you will not be permitted to touch that money until the age of 59.5, or you may be subject to a penalty. So if you feel that you may need to touch that money before 59.5, or if the elderly person may need to touch their principal for emergency or other expenses, then it would not be an ideal vehicle. Any annuity, in fact, would not be an ideal vehicle. A similar case would be, in many annuities, there is a pass that you get. In other words, you get to pull out a certain amount every year without being subject to the penalty. But if you thought that the chance was high that you would need to pull out more money than you were permitted to pull out without having that penalty, so say it's 5%, say it's 10%, if you thought there was a high degree of likelihood that you were going to need to pull out more than that amount, an annuity would probably, again, not be an ideal vehicle. This is a complicated subject. I cannot give you specific advice. You're going to have to consult with a competent and licensed expert in your area. However, for some people, a fixed annuity can be a good complement to their retirement plan, and it can be an excellent place to put some of the money in their retirement portfolio so that they have the ability to generate an income stream for themselves in retirement, and in many cases, it can complement a retirement portfolio in that way. If you found something of use in this video, please like it, please subscribe to the channel, click the notification bell to be alerted to additional content when it becomes available. I thank you so much for joining me today, and I look forward to seeing you again in another video.